It's no secret that history loves to repeat itself, especially in the wild world of the stock market. Investors twist their minds into pretzels to convince themselves that this time, things are truly different. Legendary investor Sir John Templeton, who averaged 15% annual returns for 38 years, warned about those four most expensive words in English. This time it's different. Words that have cost fortunes and shattered dreams time and again. Blind optimism masquerading as smart investing can wipe out accounts faster than you can say bull market. Take Jesse Livermore, the pioneer of speculative trading, immortalized in the book Reminiscences of a Stock Operator. He made millions shorting markets during crashes and famously said there's nothing new on Wall Street. Speculation is as old as the hills, and what happens today has happened before and will happen again. Right now, there's a forgotten stock market bubble echoing loudly in our current economy. Imagine John, a 30-year-old American engineer, pouring his savings into what he thought were unbreakable stocks. Sorry, he felt invincible, but reality hit hard, leaving him questioning every financial decision he ever made. This bubble isn't the dot-com crash of 2000 or the 2008 meltdown that shook the world. It's one you might not have heard of, but its pop was devastating and lessons timeless. When it burst, the market plunged 50%, giants lost 60 to 80% of their value. Inflation skyrocketed from 3% to 11%, and recovery dragged on for 8 long years. We're talking about the Nifty 50 bubble from the early 1970s, a cautionary tale worth remembering. Picture the late 1960s, America riding high on a 20-year economic boom after World War II. Factories hummed, suburbs sprouted like weeds, and confidence filled every corner of the nation. Americans felt unstoppable, having defeated Germany, landed on the moon, allegedly, and even invented the Etch-a-Sketch. Life seemed perfect, with money flowing and optimism blinding everyone to potential pitfalls ahead. Amid this euphoria, the stock market soared over 350% from 1945 to 1970. This epic bull run birthed a new investing mantra: one decision stocks. The idea was simple: buy powerhouse companies so dominant that selling never crossed your mind. These became the Nifty 50, blue-chip giants like Coca-Cola, American Express, and McDonald's. Investors viewed them as bulletproof, eternal winners in an unbeatable American economy. For those new to investing, P/E ratio measures how much you pay for a company's earnings, a key value gauge. Back then, the overall market's P/E was a sensible 15, nothing flashy or alarming. But the Nifty 50's never-sell hype inflated their valuations to fairy tale levels. Coca-Cola traded at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at 90. On average, these stocks commanded a staggering 42 times earnings, defying gravity. The top 5 Nifty 50 stocks represented about a quarter of the entire market. Collectively, the group claimed nearly 45% of the U.S. stock market's total value. Meet Mary, a 40-year-old teacher from Chicago, who bet her retirement on Coca-Cola shares. She believed it was foolproof, a one-way ticket to wealth without any downside. But if an investment sounds too good to be true, it's often a grenade waiting to explode. Markets don't care about your confidence. They punish complacency without mercy. Are you holding on to safe stocks like that today? Comment number 1 if yes. Then 1973 to 1974 hit like a storm, toppling dominoes one after another. Oil prices quadrupled, inflation surged to over 11%, unemployment doubled from 4.5% to 9%. President Nixon ended the gold standard, shaking the financial foundations worldwide. The stock market cratered 50%, the worst bear market since the Great Depression. Overpriced stocks didn't just dip, they were utterly obliterated in the chaos. Coca-Cola shares tumbled over 60%, McDonald's over 70%, Polaroid a shocking 90%. Those one-decision stocks became financial obituaries for countless investors. Imagine the panic as your portfolio shrinks overnight, dreams evaporating into thin air. John's story mirrors this. He watched his savings vanish, forcing him to rebuild from scratch. The pain wasn't fleeting, no quick V-shaped rebound like post-pandemic. It took 8 grueling years until 1981 for the market to recover fully. Investors who chased eternal growth ended up trapped in financial purgatory for a decade. What could they have done differently? Diversifying portfolios might have softened the blow. Spreading investments across sectors reduces risk when bubbles inevitably burst. History shows patterns. Overvaluation leads to corrections, no exceptions. If this tale gives you deja vu looking at today's market, you're spot on. Mark Twain quipped, "History does not repeat itself, but it does rhyme." Today's market rhymes eerily with 1972's setup, though not identical. Back then, Nifty 50 dominated 45% of the market, betting big on their growth. Fast forward, the Magnificent Seven, Microsoft, Apple, Google, Amazon, Meta, Tesla, Nvidia hold 36% of S&P 500. 7 companies shoulder the market's weight, just like those old blue chips. They're innovative dominators, but so were Xerox, Polaroid, and Avon in their heyday. Investors treat Magnificent Seven as modern one-decision stocks, buy and forget. Valuations, Google and Meta at 28 times earnings, Amazon at 35, Apple at 37, Microsoft at 38, Nvidia at 50, Tesla a whopping 247 times earnings. Solid companies, yes, but overpriced and idolized as invincible? Absolutely. I know what you're thinking. Surely Tesla's different, right? History begs to differ. Common misconception: high PE always means growth potential, but often signals looming danger. Feel the unease as macroeconomic shifts could topple this fragile balance. Patterns repeat: Nifty 50, .com in 2000, housing in 2008, all followed similar arcs. Overconcentration breeds vulnerability. One crack can shatter the whole facade. Investors whisper the same old lie: these giants will grow forever, untouchable. All it takes is a few dominoes. Inflation spikes, policy changes to replay the drama. Warren Buffett nailed it. What we learn from history is that people don't learn from history. Here we stand, facing a top-heavy market, ignoring valuations, chanting, "This time it's different." But markets reward the cautious, not the complacent dreamers. True investing safety starts with doubting your own optimism. Reflect on Mary's regret. She wished she'd questioned the hype sooner. You can avoid similar traps by staying informed and diversified. This story isn't just history, it's a mirror for today's choices. Do you see Magnificent Seven repeating Nifty 50's mistakes? Share your thoughts in the comments. Your perspective could spark great discussions among fellow viewers. Remember, knowledge from the past empowers smarter decisions now. Stay vigilant, question the narratives, and protect your financial future. Thanks for watching. Let's learn from history together. If this resonated, hit like and subscribe for more insights.